Good evening. Go ahead and drop a comment there in the chat. We pulled the chat up on the screen. I see some comments we're already dropping into before we went live. So, welcome everyone. Good evening. Tonight, we got a great topic to discuss, which we will get into here in a moment. We'll just wait a couple of minutes here to get live on all the different platforms. Give everybody a chance to jump on before we dive into this here. All right. Some people dropping in the chat there. Mark, Ashley, Jamie, Heather. Good evening, everyone. All right. So we'll get started in just a second here for our loan officer training. Got a good training here today. Just give us 1 second here. All right. Shout out to everybody tuning in. Looks like we are good to go. So let's go ahead and get it started. We can take the chat off the screen here. All right. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. And this is our loan officer training series that we do every Tuesday at 7 p.m. Eastern Time. Now, today's topic is a great topic for us because at the Mortgage Calculator, we specialize in non-QM loans, and this is a great non-QM loan that we can use as a tool in many instances, which Jose will talk a little bit more about. So go ahead, Jose. You can go ahead and take it over. I know you got some stuff to show us as well. Oh, you're muted, Jose.
All right. Good evening, everybody. Thank you for joining us. Some of you, it may still be good late afternoon, I guess, those of you on the West Coast. Yes, today's topic, profit and loss loans. It's one very dear to our heart. Some of our best success stories have involved the use of a profit and loss loans to, as I like to say, make the phoenix rise out of the ashes, because there's many times that people think it's crash and burn, but then they come to the Mortgage Calculator. We analyze the situation. We are not constrained by all of these boxes that your typical companies are, that are just doing the old cookie cutter agency loans. Nothing wrong with agency loans. We love our conventional FHA, VA, and USDA. But as everyone knows, in the last 12, 13, 14 months, there's been quite a paradigm shift in the industry. The overall origination, I would say, probably has not decreased that much. Is just shifted over from agency business to non-QM, and it has been the self-employed borrowers. And we have quite a few now in the new gig economies that we have, that were inspired by the pandemic, people that were basically forced to create another way to make money. Right. So we have all of these self-employed borrowers out there seeking ways to get loans to be able to qualify for homes that maybe they were approved for or pre-approved for previously as a full doc borrower. They were shopping around, inventory's a little tight, may have taken them a little time to find the home. And now all of a sudden, boom, markets, interest rates change. The inventory is still tight, and they're trying to figure out what they're going to do. And those that have a choice, that were able to look for other options, mainly our self-employed borrowers, have done it in droves. Most of them have gone over to a bank statement options. And when the bank statement option is not possible, our profit and loss loan option. Obviously, our investors have the DSCR option as well, but that of P&L loans typically will have a better rate than a DSCR loan, so would usually be a better option if possible. So let me get into it here and break this down for you because this is so important. This is going to allow you to generate more business. Just like the one deal that we like to talk about, one of our MLOs, she booked a meeting with me. She comes to the table and she got this deal, her own self generated lead, and she went and was trying to figure it out because this borrower had been denied somewhere else with another lender with a full doc loan. So she comes, she meets with me, and she thought she was going to do a bank statement loan, right? Because that would have been the next logical choice, right? Didn't go full doc, let's go bank statement. So she met with me, we reviewed it, and as you shall see as we get into breaking down what a P&L loan is, we ended up at a profit and loss loan. I'm not going to tell you all the reasons why because they're going to be here in the next few minutes in this presentation. But what I will tell you is that somebody else lost out because they weren't an MLO at the mortgage calculator. Somebody else lost out on $1,056,000 loan. That was her own self-gen, her paid for campaign. So that's 1.5%. So you can do the math. It's roughly almost $16,000 that she got from her first deal. Now that would not have been possible had she not have been here at the mortgage calculator, and it definitely would not have been possible had she not received all the support that she received from us and from me to help her, guide her, enlighten her as to what she really was dealing with, what she was not dealing with, and what she could really do with what she had, unless she wanted to crash and burn, like the last MLO that tried to, as I like to say, force that square peg into a round hole. So, what is a profit and loss loan? A profit and loss loan is a loan that uses an unaudited profit and loss report to qualify the borrower. So be aware what we're talking about here. It is not a tax return, right? No tax returns here, but it is considered a full doc loan, but it is unaudited. That is the key, right? So there's certain certifications that the person that provides the report has to give, as you'll see. But the main thing to note when you're consulting your borrowers is to allay their concerns. There's not a tax return that we're giving here, and it is not an audited P&L because there is such a thing as an audited P&L. That's something you would usually provide in a full doc loan. They're going to require you, if you're like 9 months into the year and they want to know you're making the amount of money that you need to be making, they're going to ask you for a P&L, and it's going to have to be audited. But in our example here, it is not audited. It is unaudited. Now, real important to note here that the report needs to be prepared by a licensed individual. Now, the whole point that I would say here is that if it is a CPA, and excuse me 1 second, please, I'm sorry.
The one thing Jose didn't put on here that I want to make sure everybody understands, there's basically three different categories of a profit and loss. There's self-prepared, which we sometimes ask for on a conventional loan, right? Jose, self-prepared. Then there's unaudited, but prepared by an accountant or CPA or tax preparer, etc. And then there's audited. So I did want to say that, Jose, there's actually kind of a third category, the self-prepared, which is, anybody can do that, right? You can write it on a piece of notebook paper. I made this much. I spent this much. It's not really much value behind it. So there's kind of a continuum, right? There,
Right, but
Jose.
but there's a very limited scope in which they will actually let you use that. For most of our non-QM type options here, it has to be prepared by a licensed individual.
And the key thing is a third party too, right?
Yeah.
It can't be a spouse that's also a tax preparer or a spouse that's also a CPA. That's another point. We had one borrower that was a CPA try to prepare his own audited profit and loss, right? That was little bit of a conundrum. So yeah, just a couple little caveats there. I just wanted to point that out.
Yep, thanks. Absolutely. What I really wanted to stress here is the term CPA, because that's very, very important, because as we know in non-QM, we do not have homogeneous guidelines, right? The guidelines tend to be investor specific. So when you're looking at all the options, they're going to vary. Some actually require the CPA, when they say CPA, to be an actual CPA, nothing but a CPA, and an actively licensed CPA. But most they do not require. When they say CPA, they'll tell you, we don't really mean CPA, even though I don't know why they keep using that word, but they'll tell you that it can be a licensed tax preparer, or a licensed CPA, or an active status enrolled tax agent. That's somebody that just does tax returns, but they have to, what I mean by active status is active in the system that the IRS uses to submit tax returns online, right? And these then, there are links that you can check, verify all this information with the IRS. So keep that in mind, because that has caught people at the end when their file is going to final review. All of a sudden, somebody points out to them, hey, your letter is not from a CPA. And now what do? Now you got to, if that person that prepared that report is not, doesn't meet the requirements, then basically you got to pick another option, because the CPA or the tax preparer, or whoever, is the licensee that prepares that report, has to certify in the letter that they have an established relationship with the borrower. It can't just be somebody that randomly you pick out to, hey, can you just, prepare some P&Ls for me? No, that's not the way it works. So imagine if you submit the docs and all of a sudden they tell you the letter is not good from that person. Now you're stuck. You can't just make it up and say, well, that's not the guy, it's this guy. No, you got to then go to, resubmit, and it's a whole conundrum. So please look at those little details to be sure that that is good, because you see it's real important there. That's burned more than one person on these deals. So who qualifies for a profit and loss? That's really important. Now, I will add a little note here before I get too deep into this. We do have many P&L options. This is not a one and done presentation here for P&L. It's hard because we have thousands of programs and probably tens or hundreds of P&L options. So I can't really incorporate every single guideline here. This is just setting a mindset on how you should approach the P&L loan to make sure that you cover all of your bases, dot your I's, cross your T's. So we're throwing some of these things are general, combining some options, some guidelines from the different programs to let you know what would be some of the limiting factors. So definitely self-employed borrowers only. And they have to have some type of vesting in the business. That vesting is usually going to be minimum 25%. Now that's one of the details there that I mentioned that could change from option to option. So do not assume that it's 25% for every option. I'm just telling you the minimum you're going to be able to get by with is 25% vesting in the business. You reach out to me and I'll let you know which ones it is. I'll also let you know which are my favorite ones, the ones that I think are going to give you the least headaches, which are the least headache P&L options, because they're all not the same. Some are very easy. So you got to be a citizen or a permanent resident or a non-permanent resident alien with U.S. credit. What's a non-permanent resident alien with U.S. credit? Well, that is somebody legally working here in the United States with a work authorization permit, right? They could be one of those H-1B1 visa people, specialty workers, whatever it is. They don't have a green card, but they are legally here. They have a visa. They'll be legally working here, and they have U.S. credit. That's a non-permanent resident alien. They are eligible for pretty much all the loan programs that a resident, U.S. resident, or a U.S. citizen is eligible for. Now, where it changes there is now where you get to your I-10 borrower that's not going to be eligible for a profit and loss loan, and your foreign national that's not eligible for a profit and loss loan. As you all know, the I-10 borrower has an international tax ID number to file their tax returns, but they don't have legal status here. They don't have a permanent resident card. They don't have a work authorization permit. They're in a gray area. They are able to get loans, but not a profit and loss loan. And obviously, a foreign national is a citizen of another country, not U.S. citizen, not U.S. resident, and not a non-permanent resident alien either. So foreign national, they're not eligible for profit and loss loans. Also, no non-occupant co-borrowers for a profit and loss loan. And this is possible for primary, second home, or investments. Now, what I did want to state also is we do have some options that allow us to combine different income types. Now, that's a very specific option that is definitely not across the board, where we can actually combine a bank statement with P&L with W-2. So depending on what makes sense, what you can provide, as long as you abide to each individual guidelines, you can have something like that, so that is available, not usual, difficult, but is a possibility. So, and here is the key, this is where if you're going to make the deal, right? This is what I met when I met with the MLO, when she brought her bank statements to the table and the tax return to the table and everything, and we looked it over. This is what we have to look at. Now, obviously, profit and loss loan is a good option when the tax returns don't fully capture the cash flow for the business. But beware, because some profit and loss options actually ask you for a tax return as well. I don't know how they figure a P&L. That's not the one that I like to do, though. That may be the one that has a 0.25% lower interest rate. But that's the one you talk to your borrower and let them know what's really going on there. And you got to have that heart-to-heart consultant talk to really make sure you're going to close the loan. Because as I like to say, it's not just about the rate. It's about closing the deal in a manner that is a pleasant experience for the borrower. You don't want the borrower to go through an experience where they feel like you're pulling their teeth without anesthesia, because they may cancel the loan on you before you close, or if it does get to closing, they'll never refer you a deal again, ever, ever, ever. So we don't do a one and done deal. We establish business relationships with our borrowers for life. You want to do second, third, and if you're long enough in the business, fourth generation deals. So please keep an eye on viability of the deal. But it would be best to do a profit and loss instead of a bank statement, if you have declining deposit trends. Now, what exactly do we mean by that, right? Okay, this is a little bit of bank statement 101, but the bank statements, we go 12 or 24 months. We like to go 12 months instead of 24 months because it's easier to control the trends, because the longer you extend the look back period, the higher the possibility and probability that you're going to have issues. And some of the issues we have with bank statement loans are, again, declining deposit trends, too many NSS, right? Too many overdrafts, or what was the issue with the P&L loan that I helped our MLO with, unverifiable large deposits, right? That was a big one. This person had only like 5 deposits in the whole year, and each deposit was over $200,000. And when we asked him, could you provide documentation for it, he said, it's a little bit of this. And he started talking about all these weird contract setups and this and that. I'm like, no, this would be a nightmare This would not be able to be explained. It will go back and forth forever. It's not that much of a difference anyhow. So let's just go P&L and get a couple of extra docs. And that's what we did. So this is the key. This is what you got to look at. If you got these things going on here, the bank statement loan is not for you. The P&L loan is for you. So what are some of our requirements? I will be glad to let you know that we can go as low as a 599. Yes, you heard me correct. 599 credit score at a 65% LTV. So that's pretty amazing. I confirmed that before I ran my quote, went and checked the matrix. I want to make sure I didn't believe it. And nope, 599. You can actually do that, which is great. Now, obviously, most options are going to be higher than that. That's one of our options, which happens to be also my favorite go-to for the P&L. Reserve requirements as low as 3 months. That's pretty good. A lot of them are 6 months. 3 months is the low. And by the way, that happens to be from my favorite guideline as well. So hint, hint. Now here is where it gets a little dicey, and where if you don't dive deep into the guidelines, you're also going to get burned, because some P&L options require bank statements as well. So, why are you going to be doing a P&L loan if they're going to be asking you for, at least 3 months of bank statements, right? That's a risky, because if you have any of those issues that we're talking about, that could kill your P&L deal. I didn't note on there, but I did mention already that some actually require a tax return. Those are the ones with the lowest rates. So I don't know about that. Now, we have options that may not require a trade line, as long as they have may not require a trade line, as long as they have 3 FICO scores present. And I got a misprint there. If you have at least all 3 FICO scores present, you are not going to have a minimum trade line requirement. Now, obviously, that's a very out there option, very few of them. So keep an eye. That may be an option for you, but not usually. But the 599 is pretty darn low. So what are some of the properties and LTVs? Well, obviously, single family, warrantable condos. Watch out for the non-warrantable condos, which are condos that don't fit Fannie Mae guidelines for reserves. They could have too high of a delinquency rate on their on the HOA. They could, it could be maybe too many tenants as opposed to owners. Anything that would render a condo not financeable in a regular Fannie Mae full review loan is going to make that non-warrantable. Another thing that would make it non-warrantable is if it's a new property, not yet more than 50% sold and still under the control of the developer. That would also be a non-warrantable condo, right? 2 to 4 units are good. Modular homes are good. Remember, modular home doesn't mean a manufactured home. Manufactured home is a totally different situation, but they will do modular homes as long as they are not a unique looking modular home. Modular homes tend to look like a normal home. What makes them modular is that it's like prefab. They're prefabricated at the factory, pre-wired, pre-plumbing, and then all those individual pieces are brought together to the job site, assembled, and most of the time they look like a normal stick-built home, as we like to say it. But you got to watch out for property conditions, just like in any other loan. It's anything C5, C6, fair or poor is not going to fly. Again, we talk about unique properties like geodesic domes. In most cases, also manufactured homes aren't going to be allowable either. ALS, of course, adult assisted living facilities. And you got to watch out for the acreage. So keep an eye out. The acreage is going to vary. Some will tell you 2 acres, some will tell you 10 acres, some may tell you 20 acres is fine. So that does vary from option to option, but you got to keep an eye out on these points that we're bringing up here. Right. And real important here, when you are reviewing the P&L, when you are reviewing the deal, there are pretty strict requirements on the existence of the business, right? You're looking at minimum of 2 years. Now, keep in mind that if there's been a change in the business name, maybe they sold one company, bought another company, you do that poses additional requirements and restrictions where they'll allow it, but then they're going to require at least 5 years in business for the individual in the same line of business. So keep that in mind. If they change business, then if they've only been in business for 2 years and they've had 2 different businesses in those 2 years, look really hard and deep to make sure that you can do it. Now, some options do allow you combining P&L from different businesses, but then those businesses would each need to meet the minimum 2-year requirement. And keep in mind when you're reviewing the income and you're reviewing the expenses, put your underwriting hat on and ask yourself, does this make sense, right? Especially for the type of business. If it's a overhead intensive business, with a lot of manpower and vehicles and this and that, then, it better be reflected on the P&L as well as obviously the business needs, the income needs to make sense also, but the expenses.
Can you talk about that a little bit, Jose? That's the one thing that is kind of, I guess, subjective there on these is it should roughly match the expense ratios that they apply to bank statements, correct? They're gonna look at it and they don't have necessarily a guide always, but what are they looking for here? Because you're talking about it, you're dancing around it. But
again, they're talking about the expense factor and the profit ratio for the businesses. It has to make sense. That's why
So are they just kind of using the bank statement as a guide? Is kind of generally the vibe that I'm getting, because there's no written guide, right?
Yeah,
gotcha.
Correct.
Okay.
So you could, hint. I would tell everybody here is most of the options that offer profit and loss loans also offer bank statement loans. And if you look at their bank statement loan option and you see the charts that they have set up, if that option has that, they are going to view that chart the same way when looking at your P&L loan and say, does it make sense that a retail convenience store has a 30% or a 20% expense factor, when usually they look at him as having a 70% expense factor in some of those charts that you look at, or a contractor, where they know this person's, buying a whole lot of materials, right? So all that money coming in, it really has to make sense totally. So I would try to look to see if they have any of that guidance in their guidelines and the bank statement loans, and then, try to project that info to the profit and loss loan only, because that is a very subjective situation. And that is where the letters that you're going to get, your third party verification letters that you're going to get from the tax preparer, has to make sense, because that tax preparers, they're going to prepare a letter on letterhead, which is going to be the format to provide the profit and loss, and then a separate verification letter, which is going to be essentially a business narrative, right? Where they're going to talk about their percentage, the borrower's percentage of ownership in the business, how long they've owned the business, the type of business that it is. They're going to touch on, and they should. You got to look at the guidelines for guidance on these matters. Depending on where you're sending this loan to, they may require more detail in the narrative, getting down to, employees, vehicles, overhead, offices, locations, a whole lot of stuff, so that they can say, does this really make sense? So if they're putting something on that P&L, then that may be a little bit different. They really got to have a strong verification letter to tie it all in together, because that is the purpose of the verification letter, to restate everything's there, and then, show the tax preparer's relationship with the borrower, that usually they're going to require them to state that they've, prepared at least the most recent tax returns for the borrower. A lot of that stuff is really important. Some detail, obviously, I didn't put in here in the presentation, but again, my point here is to enlighten you, give you the mindset to know how to approach this loan so that you can do your research. I'm basically teaching you how to fish, right? That's what we're doing here. Very important. The expenses need to be itemized, right? They can't just have general sections here. They got to break it down. This is like a balance sheet almost, so an income statement is basically what it is, income and expense statement broken down to the T. So this is what's going to make or break your deal, right? So this in tomorrow's training, we're going to have we're actually going to break down the scenarios more under the different scenarios that you would use, the profit and loss. We're going to break it down into actually providing quotes for the different scenarios for you, the primary, the investor, the 2 to 4 unit. We're going to give you some, like could be real life examples that you're going to face as loan officers, to then basically teach you how to apply the theory that you learned here in real life.
Perfect. Okay, I don't see any questions, so I think we can go ahead and wrap it up. Oh, Nick's
I got a question, Jose.
All right.
What's the best strategy for them to start originating one of these? Or would you suggest they get a self-prepared P&L to then present, or do you suggest that they try to get a full P&L from the accountant before they start down this road? What are they using for their initial setup of the file?
I mean, I would tell you they got to look at those guidelines, because most of them are going to require the P&L to be prepared by a licensee of some type, tax preparer, CPA, or an enrolled agent.
But like on day one, I'm saying, what are you doing when you're starting to structure the file? Are you using their tax return as a rough guide, or are you using their just kind of a self-prepared number?
Well, I asked them if they have anything like that, because some people, do their own accounting on QuickBooks, stuff like that, and they give the information to the tax preparer, right? And the tax preparer just certifies it for them when they do their tax returns. So definitely you would want to find out everything that they have available, review it, see if it makes sense. But in the end, they would have to, when you're going to submit to underwriting, it should be in the format on the letterhead of the tax preparer, just to give it that much more authenticity.
Beautiful.
And the bank statements, right? Because that's how Jose came to the conclusion for the other person.
Oh, well,
bank statements, looking at them and then saying, okay. So I think Nick is kind of more saying, okay, you said, hey, bank statements aren't looking good. How's your business doing on a P&L, right?
Yeah,
so
absolutely. Yeah, you would be reviewing the bank statements to see if bank statements is an option first. That's probably the route. I mean, how the route would probably go here is, as you know, when we keep reaching this point, we're going to review tax returns to see if they qualify full doc, right? Because we owe them the benefit of trying to give them the lowest cost loan option. We don't want to just be lazy and not do our proper full job as a consultant that we're supposed to do. That's how you get referrals. people know when you care and when you're really trying to help them. So we would look at full doc, unless a borrower tells me, Jose, you know, I haven't done a tax return in 4 years. I just got all sorts of extensions going on. It's a battle. I'm battling with the IRS and I don't really want to go there. Okay, now you know tax returns are out, but you're still going to ask them for the last, 12 months bank statements as well. Unless they tell you, Jose, my bank statements are terrible. I mean, but you got to go through the motions and ask. Most of them want the higher LTV, lowest cost option. So they're usually going to like the fact that you're offering to review as much information as you are.
Perfect. Okay, so as Jose said, tomorrow we're going to go over a little bit more in depth in this on the sales training and talk about real examples and then how you can apply this to your actual sales cycle there, into your sales process. So we do this every Tuesday, 7 p.m. Eastern, with these loan officer trainings. And then we do our sales training every Wednesday, 7 p.m. Eastern. So we will continue this tomorrow night, 7 p.m. Eastern time. And then, of course, remember, we have our daily mortgage rates live every weekday that we do on our YouTube channel. So you can tune into that 11 a.m. Eastern every weekday. Thank you, everybody. And we will see you tomorrow, Wednesday, 7 p.m. Eastern.
Thank you,
everybody. Have a good night.
Thanks, everybody.
Thank you, everybody. Have a great night.